Hello, friends. Welcome back to the channel Wish You Wealth. So, today we are talking about investment risks. Like, while investing our money, we have to take care of the risks. So, different type of risks are inflation risk, liquidity risk, credit risk, market risk, and interest rate risk. Inflation risk is that at what rate inflation will be there, like at what rate the prices will be increased after a certain period of time. Liquidity risk is where we are investing the money. So, what is the convenience of liquidating that money, that whenever we require that money, we can have the liquidity or not? So that there may be, that means there should not be any lock in period in that investment instrument. Second, third is credit risk, that if we are giving or putting money in any of the investment instrument, our money is not foregone, that no one is defaulting with our money. So we must get our money back with return rate of return, and our money must increase more than that of inflation. Then there is market risk. Market risk will be in basically in stock market, that if we are investing in equities, so what will be the situation of market? So that is the market risk. And interest rate risk is that the we must get the rate of interest rate of return more than that of rate of inflation. So there is one thing, the future value of money. So if we are taking investment inflation in mind, so that is our money must grow more than that of inflation. So there is one formula, that how much money is required 5 years down the line if the rate of interest is 8%. So to calculate the future value of money, the formula is A is equal to P into 1 plus R power n, where A is the future value of money and P will be the present value, and R is rate of inflation and n is time. So if we take example as 10 rupees 10,000 as example, like today if we have 10,000 rupees, so after 5 years how much money would be required to buy a product which is today costing 10,000 rupees? So 10,000 into 1 plus R, that is rate of return, power 5, that is after 5 years, that is the time. So it comes out to be 14,693. So if we have to buy something of rupees 10,000 today, so after 5 years we would require 14,693 rupees if the inflation is at 8%. So this is the way to calculate the future value of money. Then we are talking about risk measure and management strategies. So to measure and manage the risk, we have to avoid unnecessary risk, take a position to benefit from some events, and diversify our fund in different asset classes. As we have discussed about many asset classes, equity, real estate, commodities. So we have to put money in all the asset classes, not only in the one or two asset classes. And we must avoid unnecessary risk. Then the other thing is behavioral biases in investing. So we have many biases, like we invest according to our biases, like availability heuristic, confirmation bias, flexibility bias, familiarity bias, herd mentality, loss aversion, overconfidence, and recency bias. Availability heuristic is which financial instrument is available, most available. Confirmation bias, in that in which we are confirmed of that much amount of return. Familiarity bias is which we invest in the financial instrument which we are mostly familiar with, like most common is fixed deposits with the banks. Herd mentality is where everyone is putting their money, and we also think of putting that money in that asset class. Loss aversion is basically fear of loss. If we are apprehensive about putting money in equity, even if the equity gives maximum return, we don't invest in equity market. Overconfidence is just opposite of loss aversion. Like if we are overconfident about equity market, we put our entire money in same equity market, and if we don't calculate the market scenario, we may have to suffer losses. Then recency bias is about recent events. Like recently there is a war between America and Iran, so according to that event, so we would many people will abstain from investing in the any kind of financial asset class. Then risk profiling is like, as a mutual fund distributor, we have to do risk profiling of our client. Like the client has to need to take risk. Everyone has to need to take risk if they want to invest money and let their money grow. The ability to take risk, that our client is he able to take the risk or not, and if he is able and willing to take the risk, up to what extent he can take the risk of investing their hard earned money so that the money can grow. And then there is asset allocation. Asset allocation is a process of allocating money across various asset categories in line with a stated objective. So everyone's objective is to grow the money more than that of rate of inflation. So according to that, we have to help our clients to invest the money in the different asset, that is called asset allocation, putting the money in different assets to grow the money more than that of the rate of inflation is called asset allocation. The types of asset allocation is strategic asset allocation is basically long term, tactical allocation is short term, and dynamic asset allocation is rebalancing its variable, and according to the market scenario and situation, it is always, it keeps on, we change according to that. So this is all about asset allocation and risk management. Please like and share this video and subscribe to Wish You Wealth. Thank you very much.